All right, well, we'll go ahead and get started. I think you'll get a lot out of this. This is something that I'm personally very passionate about and wanted to share with you guys as interns, co-ops, say younger employees, and wanted to just impart some of this to you to make sure that you've seen it, to make sure you're familiar with it as you finish up school and start out in the work world. Well, a lot of what we're going to be covering today is, let's call it generic or broad financial advice. So I will put up this disclaimer here that I'm not giving you individual advice or specific to your situation, that I'm not licensed to work with you in that way. And this is much more along the lines of general concepts and general advice. So some things that we're going to talk about today: saving, debt, taxes, building your credit and your credit score, your credit history, investing, which is a long-term thought, not a short-term thought, buying a home, potentially, types of insurance, when and why you might need insurance, and how to find and when you might need a financial advisor. So let's just go ahead and dive right in here. I will hold a few minutes at the end so that we have some time for questions and answers. So you guys, you're smart. Definitely, you know basics of spending and budgeting and saving. It's not rocket science, right? Any kid can understand. You spend less than you make, and you're going to be able to save. If your outflow exceeds your inflow, then you're in trouble, right? You're spending more than you're taking in, and then you're going to the red. Well, as you get out on your own and providing for yourself, maybe living with roommates, having a job, spending, you're going to need to start to track your expenses. Otherwise, it very easily can get away from you. There are some pieces of software out there that can do that. Quicken, of course, Microsoft Money, Mint.com is very popular, Microsoft Excel. You just want to set up a basic spreadsheet to track your inflows and outflows. That's perfectly fine as well. But what you're going to see when you start to do that is these small expenditures really do add up. And anyone that has a credit card can attest to the fact that $5, $10, $5, $10 on a credit card statement, you get to the bottom of that statement and say, how in the world could these small expenditures possibly add up to this big number? That's what I want to shield you guys against, is getting in a situation where you let your expenditures run away from you. So keeping tabs on that, especially early in your career, is going to be really important. Also, I want to impart some wisdom here as far as planning for the unexpected. Call that an emergency fund. We're going to talk about that in just a second. But make that part of your budget. When you plan for the month, when you plan for how much you need to have at the end of the month so that you're meeting your goals, make funding that emergency fund part of it. And once you have the emergency fund funded, then make savings part of your budget. It shouldn't be an afterthought. It should be one of your top line items to save money for the future. If we go to the next slide here, let's think about the emergency fund. The idea is that we're talking about a safety net. And you guys are going to run into this if you haven't already. They're unexpected expenses. You get in your car one day, you put in the key and something doesn't sound right. You take it to the mechanic and it's $1,000. Right? That's an unexpected expense. Computer dies, your washer and dryer goes out. These are things that just happen in life, and you have to have money set aside ready and anticipating those types of things. And then, of course, the biggest one is you lose your job. That's happened to me in the past, and I went a fairly long period of time between opportunities, and having a safety net there was a total lifesaver. We did what a lot of couples wouldn't ordinarily be able to do, which was live fairly comfortably while not having a job, because we had planned for those types of circumstances. So typically we think about emergency funds being around 6 months, depending on you and how you feel about risk. Even 9 months may make sense, and that's 6 to 9 months of living expenses. So if you're a single person thinking about how much it costs per month, it may be a $20,000 emergency fund, maybe less than that, maybe more than that, but it makes sense to have that nest egg and that safety net. Let's think a little bit about a basic formula that's a net worth formula. And the idea of a net worth formula is that it's basically what a balance sheet is for a company, right? A company keeps a balance sheet of all their assets and all their liabilities so they know how much the company is worth. We need to do the same thing for ourselves as individuals. What are our assets? What are our liabilities? And then the difference between those is net worth. Of course, you want that to be positive. If you're negative, then that's an issue. And you guys may be negative, fresh out of school with student loans. That may be the case. But as you get into your adult life, we definitely want to turn that around and be, driving into the positive side very quickly. So as we think about this concept of a balance sheet or a net worth statement, you always think about financial decisions in this way. And I think it's going to really help you guys make decisions that make sense. It's easy to get caught up into thinking of, oh, I'm going to take money from my savings and I'm going to put it over here against this car loan. So let's think about that for a second. If you take $5,000 out of your savings account and you apply it towards a car loan, and let's not think about interest and all that for a second. If you just move it from savings account to pay down your car, is that a financial move that increases or decreases your net worth? If you think about it in the terms of this table that I have set out, you realize that no, it's not a move that changes your net worth at all. It reduces your assets and it also reduces your liabilities. So in this example, you would continue to have $3,000 net worth. Of course, in real life, one of the things you want to ask yourself when you have that kind of situation is, what is the interest rate on the auto loan? What's the interest rate that I'm earning in my investments? And at this point in time, or at a very interesting point in time where car loans are sometimes in the 1% range, 1.5, 1.75, it may make total sense for you to not pay down a car loan and to keep money in a savings type vehicle. So while we're thinking about these topics of savings and investing, let's talk about the difference between banks and credit unions, because this is a very basic core concept that you guys are going to need to know. At the most core level, banks are owned by the shareholders, right? They're for-profit institutions. They're typically public. They have shareholders, and their goal is to make a profit for the shareholders, as any corporation's goal is to make a profit for the shareholders, right? Credit unions, on the other hand, are owned by the members. So if you are a member of a credit union, you are also an owner of the credit union. So instead of trying to make profits for the shareholders, their goal at a credit union is to take what would be profits and actually disperse those back in the form of better rates, better return on savings vehicles, mortgage rates. So whatever it might be, lower fees, they're going to be able to pass that along to you because their goal is not to make a profit for the shareholders. It's probably a good idea for you to go ahead and join a credit union. They typically, don't cost anything to join. Typically, to set up an account, they ask for $5 or $10 or something like that to set up an account. What's really important is you go ahead and set that up while you have the opportunity. So for you guys, if you're interning with IBM this summer, you're eligible to join Coastal Federal Credit Union. You should go ahead and do that, right? That's something that you should go ahead and do while you're eligible, and that's going to make you a member for life. And at some point, if you have to make a financial transaction and you need a loan, they're going to be a good place to go check out and see if they have a better rate. It just gives you options. There's no reason not to take advantage of that. Going on to the next slide here, let's talk about some basics of debt. And I think the first concept I want to address here is good debt versus bad debt. And some of you would say, well, what's good debt? I've never heard of good debt. If you look at very profitable corporations, most of them take on debt to be able to grow in the way they need to grow. In that same sense, as individuals, some debt is bad, some debt is good. For example, a credit card with a 25% interest rate and you're revolving that debt month to month, that's really bad debt. On the other hand, if you have a 1% car loan or a student loan that allows you to further your education and progress further in your job, those may be okay kind of debts to have. But essentially, think about debts. What you're doing is you're just comparing with what you could earn in another type of investment. So if you say, well, I could pay down this 10% credit card or I could put this money in the stock market. Well, the answer there is clearly pay down the 10% credit card because you're not going to be able to get a guaranteed 10% somewhere else. And paying it down is a guaranteed return. Again, if you have a car loan, or maybe even some of you guys have mortgages that are at exceptionally low, 1, 2, maybe even 3%, you have to ask yourself, if I pay down this loan at 2% interest, and that's a guaranteed return of 2% or 3% or whatever it is, would I rather have that or would I rather have the return in another vehicle? And so I can't tell you the answer to that. That's a personal question that you have to answer based on your risk tolerance. But that's the way that I want you to think about it. It's always a trade-off. It's trading one for the other. Now, one thing that you might have heard is that mortgage debt is tax deductible. And that's another reason that mortgage debt is not necessarily bad debt. Mortgage debt could fall under the sort of the good debt category. And what does it mean to be tax deductible? So very simply, and we'll get into taxes a little bit more later, but if you have taxable income of, let's say, $40,000, and then you have a $5,000 tax deduction, that brings down your taxable income. which of course brings down the taxes that you owe. So credit cards, good or evil? Well, again, there's no easy answer to that. My answer is neither. It depends. It depends on how you use them, right? It's not the card itself. It's how the person uses it. So let's think about the pros of credit cards. Well, credit cards help you build credit, and that's something that's going to be very important in your adult life, is building a credit history and a credit score. They help you track your spending. They help you reduce fraud. If you have $500 in cash in your pocket and that gets stolen, well, that money's gone. But if you have a credit card stolen, or someone steals your identity or something like that on a credit card, your liability is limited to $50. Some cards even $0. Right? And so that's a very good protection built into credit cards. And I will mention that debit cards often do not have the same kinds of protections. It depends on the issuer and the card that you have, but typically not as strong as what you get with credit cards. Another benefit to a credit card is earning money back. I have a card that pays 2%, which is one of the best cards I've seen. Some of them give you airline miles. So there's a lot of rewards that you can find on these cards, and I suggest you just go out and do some Google searches and find those out there. There's always sort of a points to dollars ratio you want to think about. Credit cards allow you to shop online, and as we all know, shopping online a lot of times is where you find the best deals. You have a 30-day grace period. You can charge it on the 1st and pay it off on the 30th, and as long as you're not revolving debt from month to month, there's no charge for that. You can charge something on day 1, pay it off a month later, and there's no interest. That's what they call the grace period. However, let's think about the cons now. They are potential hazards. If you're the type of personality who is easily tempted by spending, or has the temptation to get in over your head, this may be something that you might not want to do. So it is easy to get trapped. Certainly, if you're not paying off the debt every month, then that is going to be a big negative. That's going to cost you a lot of money. They sometimes have very, very high interest rates if you're not paying it off. There's a lot of fees. They sometimes try to get you with late fees, over the limit fees, didn't pay your balance fee, all kinds of fees that are sometimes associated with cards. So again, it's important to find a card that doesn't have a lot of gotchas. Go do some research, potentially get one through your credit union. For example, my credit union has a really good cash rewards card with a low fixed interest rate and several other features. You can get these things that have like price protection and rental car insurance. So a lot of these credit cards, especially from credit unions, are really good deals. So if you can handle it, it's probably not a bad idea for you to go ahead and have 1, 2, 3, 4 cards, because that's going to help you build your credit. So why is that important? Well, let's think about what a credit report is first. So when someone is going to lend you money, whether that be for a home, a car, maybe they're selling you insurance, and that's an instance where they look at your credit to decide what kind of risk you are. It's going to be very important for you to have a good credit score. Your history, your credit history, is just a list of all the borrowing and paying back that you've ever done, and a score is just a single number representation of that. So that can go anywhere from 300, which I would hope that no one would ever be in that ballpark. I can't imagine what you'd have to do to get 300, all the way up to 850. Where I'd like to see you guys is at least in the 700s, hopefully in the high 700s. And that number is going to be comprised of all the things that you've done. And some of them are within your control, like how much you owe, and that's a ratio of what you owe divided by how much potential credit you have. Length of credit history, which is not necessarily in your control, but if you get started early, that's going to help you over the years. Things that you've applied for recently. So those are all going to boil down into this report. So how do you find out what's in the report? Well, you guys have probably seen the commercials, people singing, and it's like, college students, and it looks so cool, and you go to this site, and then when you get there, you realize it's something you sign up for, and then they're charging you month after month after month. Well, there are 2 places that I know of that are legitimate services where you can get free credit reports. The first one is annualcreditreport.com that I've got up here on the screen. And you have to really pay attention to that URL because there are lots of websites with a very similar address that are not this site. This is the one that's actually an official government-funded site. It gives you 1 free copy per year of each of the 3 agencies. And so the way that I've done that is I've set that up on my calendar so that every 4 months I remind myself, hey, go get one of the agencies. there's 3 agencies, Equifax, Experian, TransUnion. So I just make myself a note, go get TransUnion on the 1st of April, go get Equifax on the 1st of August. The other one out there that's free is called Credit Karma. It is pretty ad heavy, but I think you guys know the difference of what to click on and what not to click on, but you can get your report that way. And the benefit of Credit Karma over Annual Credit Report is they actually give you a score as well. Annual Credit Report only gives you the history without a score. Credit Karma gives you a score, although it's not the official FICO score. It is a score estimate, which is certainly better than nothing and pretty good for free. You can pay to have a credit monitoring service. Credit Karma has some of that built in. If you want to do that, that's fine. It's I would probably not pay more than about $10 or $12 a month for that. But another way to do it is to freeze your credit. If you say, hey, I'm the kind of person who's not going to be applying for credit more than once a year, once every other year, something like that, I'm just going to freeze my credit. That's going to lock it down so that no criminals or no mistakes can be made on your credit without you going and explicitly thawing credit. I guess in this video, you guys are not going to be able to click on this link. So go out and Google Clark Howard's guide to freezing and thawing your credit. You'll find his guide on clarkhoward.com. He's got a really good, concise, step-by-step guide on how to do that and what that means. So the next thing I told you guys that I was going to talk about was taxes. This is going to sound kind of negative. I don't necessarily want it to. I want you to understand what taxes, what different types of taxes are out there and what you guys are obligated to pay. The first one, of course, this is the biggie, is income taxes. And in North Carolina, where I am, we have North Carolina income tax as well. So we have federal and we have state. Some states out there, like Tennessee, Texas, Florida, and a few others, don't have state income tax, which is always a nice feature if you're lucky enough to be in one of those states. Both the federal and the state rate, at least where I am, the state rate, is marginal. And what that means is that as you make more, you're going to go through different brackets. The first bit of money that you make is going to be at one rate. The next bit of money that you make is going to be at another rate. And the higher you go, that block of money is going to be at a different rate. And we'll look at a chart on that in just a second. So the next one is capital gains taxes. Anytime you guys buy something and then resell it, typically we think about that with stocks, but it could be a business. It could be if you buy an investment piece of property, you might have capital gains. But capital gains are a flat 15% tax right now, and that most likely will change in the upcoming tax year, but keep your eye on that. But right now it's 15%. Sales taxes, you guys know what that is, state and county and city. Payroll taxes, I want you to understand what payroll taxes are. When you look at your pay stub, you're going to see several things being withheld. All withholding means is they're holding it so that when you settle up, when you do your taxes in the early part of the year, they've already got some of your money, and I'll explain that in a little bit. But your payroll taxes is typically your Social Security and your Medicare. As an employee, you pay 7.65 typically, and there's been some reductions in that over the last couple of years, and I don't know when you're listening to this webcast what it'll be, but the base rate is 7.65. Now the funny thing is that your employer is also paying that. So each of you is paying half of about 15 point something percent. And your responsibility is that 7.65. Property taxes are another type of taxes. So if you buy a home, you're going to owe property taxes. But you've probably seen it on your car. Maybe if you have a boat or a jet ski or any type of big purchase like that, you're going to be paying property taxes. And the last one I want you to think about here, and I just mentioned the payroll taxes, that the employee and the employer both split half. Well, if you're self-employed, if you go out and start a business or you run something on the side and you make money, you're going to be required to pay tax on that. And the funny thing is that in the government's eyes, in the IRS's eyes, you're both the employee and the employer. And in that case, we'll have to pay both halves of that payroll tax. So that's just something to keep in mind, if you're earning money from a business that you start. So here is a quick little chart that I made up on how our income tax system works. These are what we call marginal tax brackets. And the chart that I pulled here, this is the 2012 bracket for a single person. And so that first $8,700 that you make, if you made $86.99 in 2012, you would only owe 10% tax. Now, if you made $9,000 in 2012, you would owe 10% on that first $8,700, and you would owe 15% on that $300 that went into the next bracket. So you see how that works? It's progressive. So the next break point between 15 and 25 is at $35,350. So if you made $40,000 in taxable income, you would pay 10% on the first $8,700. You'd pay 15% on the next $26,000, and then you would pay 25% on the next $4,000 and change. That brings you up to what you made. So you're progressing through these marginal brackets. So when you hear people talk about their tax rate, sometimes you hear them mention their marginal tax rate, which in my $40,000 example here would be 25%, or sometimes you hear effective tax rate, which is actually taking the tax that you owe and dividing it out over your income. So I did a little math problem here for you on the right-hand side. I said if you earn $75,000, 10% up to $8,700, 15% on the next 26, 25% on the next 50. Divided that out and say your effective tax rate would have been 23%. Now, in the little blue box here, I've got something about taxable income. And I mentioned that the number that we were talking about here was your taxable income. Well, how does that differ from what you typically think of as your salary? Well, your taxable income is your salary minus all your deductions, right? And so now you're starting to see why deductions are so powerful and so sought after, right? You want to get as many deductions as possible. Well, one of the biggest deductions is buying a house. Any mortgage interest is typically deductible. Contributing to a 401k is deductible. Property tax on your home is deductible. So all of these things start adding up, and it allows you to bring your taxable income down, which of course is going to reduce the amount that you pay. And just a side thought, I started to say this a second ago about the withholdings on your paycheck. So a lot of people get excited about their tax refund, and I just want to remind you guys, or hopefully you've heard this before, you already know this, holdings that are coming out of your paycheck are going and sitting in a bucket somewhere, and at the end of the year, you're figuring out how much you owe, and if you get a refund, what does that mean? It means that you overpaid during the year. So when you think about getting a refund, I don't want you to get too excited about that, because essentially what that means is they've been holding your money, and they've been holding more than you really owed. And if that's the case, I would encourage you to adjust the withholdings and say, hey, look, there's no reason for me to pay in to just get it back later. I'd rather have that money during the year, and I can go ahead and save it and invest it and make it part of my budget. So going on to the next slide, just want to think about investing. So we're sort of changing gears here and thinking about investing and risk versus reward. Well, if you think about a low-risk investment, what kind of reward do you think you're going to get? Well, you're going to get something that's fairly guaranteed. It may be guaranteed by the government in some cases, depending on what kind of investment we're talking about. But because it's so safe, the returns we expect to be very low. On the opposite end of that spectrum, something that's very risky, for me to be willing to take that risk as an investor, I need to expect that the potential reward is very high. And if you've ever been to Vegas, you've seen this on the roulette table. If you go to the roulette wheel, you can bet red and black, and you can say, well, I'm gonna bet that the next roll gets red. You've almost got a 50% chance of getting that right. It's a little bit less than 50 because there's a green square on there too, but a little bit less than 50% chance of being right. And so since your safety and your risk is not very high, at least by Vegas terms, your payout is not very high either. Now, if you've got the guts to put down money on one particular number, your payout is going to be much, much bigger, potentially, if you hit that number. But the risk is going to be very, very high. So there's always that seesaw effect when you think about risk and return. Low risk, low return, high risk, high potential return, and high potential loss. So the other thought about investing that I wanted to get across to you here is the idea of compound interest. Compound interest is one of those things that once you've seen it and once it's made an impression on you, it's hard to forget. When I was a kid, I learned the rule of 72, which allows you to do some quick math in your head And you take whichever variable you have, and you divide it into 72, and that tells you the other variable. So if you say, well, how long would it take me to double my money at 7%? And the answer is about 10 years. You can go the other way, and you say, in 10 years, what percentage rate would I need to double my money? And the answer is 7. And of course, it works with other numbers other than 7 and 10. I did that for simplicity, but you might say at 3%, how long would it take me to double my money? And the answer would be like 23, 24 years, something like that. And it's an estimate, it's approximation, but it's a rule of thumb that helps you do some math in your head, and it's really handy. And I've got an Einstein quote down here, and who knows if Einstein really said this. It doesn't really matter if Einstein said it. It's good folklore to say that Einstein said it, but it's true nonetheless. That compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't understand it pays it, right? Because you can be on either side of that coin. The credit card companies love you to get into debt over your eyeballs. And then you start paying them interest, and that starts compounding, and before you know it, this $3,000 credit card bill has cost you $8,000 or $9,000. And that's the opposite end that you want to be on. You want to be on the other side of that coin, right? You want to be the investor who puts in $3,000, and over several years, you look at your account, and wow, now I've got $6,000, now I've got $9,000. So that's the power of compound interest, both the good and the bad power. So I've got a little chart here I wanted to express to you in more quantitative terms. And pay attention to the left column here that shows your age, and I condensed this. There's definitely some gaps in years. So on the left-hand side, I've got the early saver. And both of these columns are people that invest $25,000. $2,500 for 10 years. So the early saver, he starts at age 21, he goes to age 30. And the magic of that is, at age 30, he stops. And he doesn't look at his account again until he's 65. And at 65, he picks up his account and he's got $578,000. His neighbor, the late saver, he also invests $25,000 in the same schedule, $2,500 a year for 10 years. But he starts at 45. Right? So he does the same thing, 45 up to 54. He puts away his account and picks it up when he's 65, and he ends up with $91,000. So they start both with 25, and they end up with vastly, vastly different numbers. And the principle there is that time is your greatest asset. You know, I've seen other charts, and I didn't put these in the same deck, but the same principle applies. It says if you put that same, let's call it $25,000 when you're young, how much more would the older person have to save to have that same 578? It's really a tremendous advantage to get started young, get started early. Every dollar you save now is $10 or $20 or $30 that you're going to have in your account when you're older. You know, we all want to live and we all want to treat ourselves to nice things, but make decisions that are going to benefit you in the future and not just decisions that are going to benefit you in the immediate term. So the next concept that I wanted to talk about is this concept of diversification. As you start investing and as you start sort of building a portfolio of things that you're investing in, one of the best things that you can do is diversify your money. And if you ask your grandma what that means, she would tell you, don't put all your eggs in one basket. Right? It's the same concept. We want to make sure that the things that we're investing in are not all the same. Or even in the same fields, for that matter, right? Like financial stocks or all U.S.-based stocks, right? And so here's a great example that I took out of one of my favorite investing books. And we're going to call this the umbrella company and the suntan company, right? And so the blue line is the umbrella company. And the pink line is the company selling suntan lotion. Obviously, those are opposite products. For our little anecdote here, they're going to move opposite each other on the stock market. And if you own either one of these individually, you would have heartburn, and you know, you'd make yourself sick riding this roller coaster up and down and up and down and up and down. But if you buy both of them, 50-50, what you end up with is that yellow line in the middle, that much smoother, gradual increase. And notice that they all three end at exactly the same point. But the idea is that you want to level out the volatility in your account to give yourself a much more balanced ride. And so that's the example there for diversification. I hope you guys take that to heart. I wanted to also go over some other terminology that you may hear as you get started in your investing career. The first one's stock. I hope you guys already know this one. It's just pieces of a company, right? It's shares. You're dividing up a company into little bits and you're buying pieces of it. However, I don't know if you guys are familiar with the word bond. And bond is sort of the opposite of stock or shares. When you think about buying a stock, you're buying a piece of the company. But when you buy a bond, you're not buying a piece of the company, you're buying a piece of the company's debt. They're essentially writing you an IOU, and let's say you buy $10,000 of bonds from a company. And they're going to say, we owe you $10,000 in 5 years, and we're going to pay you 5% interest every year, and then at the end of that 5 years, we're going to give you your $10,000 back. And that's how a bond works. A mutual fund, and by the way, on bonds, I don't want to just lead you to believe that it's only companies that do that. Of course, the federal government is probably the biggest seller of bonds. You can buy pieces of the federal government's debt, and they pay you back at a stated rate on a stated date. Mutual fund is just a big basket of stocks and bonds. It doesn't even have to be just stocks and bonds. It could be lots of other things as well, real estate, timber, commodities. All kinds of things can make up mutual funds. It's just a basket of investments. An ETF, or an exchange-traded fund, is very similar to a mutual fund. They're almost the same thing, except that an ETF trades on the stock market. It trades much more like a stock, whereas a mutual fund is something you buy through a fund family. And there are some other technical ways that the price is calculated, but it's not really as important as just to know that an ETF is something you buy on the stock market. CD, or a certificate of deposit, is a FDIC-insured investment. So, like we talked about, investments that have some sort of guarantee behind them are going to have lower returns. So CDs are very safe, they're very liquid, and because of that, they're going to have a lower expected return. Basically, all that is you're going to give the bank your money for a stated time period, and they're going to say, we're going to pay you a stated rate, and you come back in 3 years or 5 years and cash it in. A stock option is an interesting thing that I at least wanted to introduce you guys to the concept, and there's no way I'll do it justice in 20 or 30 seconds here. But a stock option is basically you're buying the option to buy a stock at a date in the future at a certain price. And the best way that I can explain this to you is, let's put this in very simple terms. Let's say you're buying apples. You think a good price for apples is $2.50 a pound. And so you go to the farmer's market and you start to think to yourself, wow, I'm worried that apples are going to go up next year. You know, it's going to be a rough crop. I'm going to negotiate with a farmer, and I'm going to buy an option in case I need it to buy apples at $2.50 a pound. Well, the farmer thinks to himself, well, I'm not going to do that for free because apples might be $5 next year. So I will agree to that if you'll pay me X number of dollars up front. I'll give you a certificate that says you can buy apples, up to 10 pounds of apples for $2.50 a pound. And so when the next year comes around, if apples are indeed selling for $5 a pound, well, then you've got something that's worth a lot of money. You've got something that says you can buy apples for $2.50. However, if the market goes the other way and apples are just plentiful that year and apples are selling for $2, well, then you're not going to use your option. Right? You're going to let it expire. There's no reason you would go buy apples for $2.50 and you could just go to the store and buy them for $2. So that's the sort of the simple terminology of stock options. Now, you don't have to buy them all the time. A lot of times employers will give them to employees as a retention tool. Say, hey, here's an option to buy our stock, our company stock, at a certain price at a certain time in the future. We want you to stick around and exercise this. So they use it as a way to keep employees happy and keep them at the company. This next slide is another one with sort of terminology on it. I wanted to make sure that you guys were familiar with these types of accounts. These are certainly not all the accounts you're ever going to hear about, but these are ones that you may run across in the next few years. Traditional IRA is the type of retirement account. Actually, these first three are retirement accounts. And IRA stands for Individual Retirement Arrangement, or sometimes you hear Individual Retirement Account. Basically, a traditional IRA and a Roth IRA are mirrors of each other. They're basically opposites. Traditional IRA says you don't pay tax now, you pay tax later. So if you put money in a traditional IRA, you get to take a deduction on your taxes, and then when you decide to cash it out in retirement, you pay the tax. The opposite is true for the Roth. You pay tax now, you don't pay tax later. For a young person, for a young adult starting their career who's maybe at an entry-level job or at the lower end of where they're eventually going to be, salary-wise, it's probably smart to do a Roth IRA because that says I'm going to pay taxes at my lower rate. You know, I'm young, I'm in the 15% bracket. I'm going to go ahead and pay my taxes at 15%. 30 or 40 years from now, when I'm 65 and I'm in a huge tax bracket, I'm going to be able to take this money out tax-free. So a 401k is another type of retirement plan that is tied to your employer. And it's very similar to a traditional IRA in that you get a tax deduction. You don't pay taxes now, you pay taxes later. But the thing that makes a 401k really nice is that typically companies will do some sort of matching. So I know you guys, when you come in and you get hired here, they have a 5% match. So you're silly not to take that, right? Who in their right mind wouldn't go and get a 5% raise for free for doing nothing? So absolutely, on day one of getting employed, go into the tool that they give you and set up your 401k matching. If you do nothing else, take the free money. And some people don't. Some people go 5 or 10 years and never set up that account. The ESPP is the next one on the list here. It's the Employee Stock Purchase Plan. It's basically saying we're going to give you our company stock at a discount. And they typically will set that up to draft out of your paycheck. And the last one that I have on this list is just a taxable account. And a taxable account is just a vanilla, regular, everyday account. That says I'm taking money that I've saved from my whatever, salary or side job or something like that. I'm putting it into account and I want to invest it, and I hope that it grows over time. So the money that you're putting in, you've already paid taxes on, and the growth that you get, the earnings, is going to be capital gains. If we go to the next slide here, I want to talk a little bit about short-term versus long-term. We all have short-term needs and we all have long-term needs. And the trick here is to think about what those needs are, when things are needed, what you're saving for. So let's say a really common one is people saving for a down payment on a home. Sometimes you're saving, okay, I need to put down $20,000 or $30,000 as a down payment on this home. I'm going to start saving for that. Where should I save? You think about how volatile, we talked about those roller coasters earlier. Do you think it's a good idea to put short-term money in something that's a roller coaster? And the answer to that is of course not. So if you look at my two arrows here, we're just going to play a scenario and say, what if we had put money in, started saving for a house at that first arrow, hoping to buy a house in 2009? Well, our savings for our down payment would have plummeted. It would have been cut in half, if not more than that. So when you're saving for something, the idea is you want to be in something much less volatile, saving for something short-term, much less volatile. And when you have long-term, you can be in something more volatile because over the long term, by that I mean 10, 20, 30 years, you're going to get a smoothing out effect. And the little ups and downs of the daily or weekly market are not going to affect you. And what you're going to see is that very slow climb, that stair-step effect, as you see here in this chart. So going over to the next slide here, how do you guys get started investing? Well, the first thing I recommend is that you start reading. There's nothing better that you can do for yourself in this area than to start reading good quality books. I've got a couple here that I recommend to you, a couple of my favorites. One is A Random Walk Down Wall Street. The other is Boglehead's Guide to Investing. I'll tell you more about Boglehead's here in a little bit. Both of those are really good books. If you want more recommendations, you can actually go to the Boglehead's website or Google Boglehead's reading list, I think is probably what would bring that up. The folks at that community have come up with a really outstanding reading list where you can get a good solid footing. And what we want to read here are not books about getting rich quick. We're not looking for books about this market system or that market system. What we want to learn is time-tested, true ways to build a portfolio. Start with these couple of books and I think you'll start to understand how to build that footing. Of course, one of the first steps in getting started is we need to open an account. Where can you do that? Well, just about anywhere. There are certainly places that are better. Discount brokerages, for example, Scottrade, TD Ameritrade, Charles Schwab, E-Trade. They're all roughly equivalent. I've got a link here, which I know you can't click in the video, but if you Google brokerage reviews, Kiplinger magazine, you'll find their breakdown of pros and cons for each brokerage. The other thing that you can do is go with a mutual fund company, one like Vanguard or Fidelity or T. Rowe Price, where you send them the money and then they hold it and send you account statements showing what your account is. So either way is perfectly acceptable. And the three that I listed here are absolutely enormous, with billions and billions of dollars under management. The next step, of course, in getting started is setting up a regular investment strategy. The best thing that you can do is set up an automatic bank withdrawal. And whatever that number is that you're comfortable with, $25 a week, $100 a week, whatever it is, get it set up and let it go over time. Because what you're going to do is, we're not trying to time the market here. We're not trying to buy low or sell high. We're just trying to buy consistently. And what's going to happen is that over time, you're going to get highs and you're going to get lows and you're going to get mids. And over time, you're going to get an average effect. But because it's regularly investing, before too long, you're going to be amazed at how much your account has built. Fourth one here is diversify. We talked about that a little bit already. One of my favorite ways to diversify if you're just getting started is what they call a target retirement account. And these are relatively new ideas. This says you pick a date in the future. For you guys, maybe like 2050 or something like that, depending on how old you are. You say, I'll be 65 and in year X. You pick the one that's most similar, and you put your money in that. And the idea of those funds is they go ahead and diversify for you. They're going to tell you, when you read the prospectus, and I encourage you to do so, that it's X percentage in U.S. stocks and X percentage in international stocks and X percentage in bonds, and they're going to tell you how that's broken out. And over time, as you get older, you and the group of people that you're with in this fund, they're going to gradually shift you to less risky things and more safe things. And that transition happens over 30 or 40 years. So that's a really great way to instantly diversify your investments. The last one is a simple thought: stay the course. This is not something that we start and stop and sputter. We want to set something up. We want to do it regularly, every month. Keep the course. Don't get drug off into market timing. Don't get drug off into the market is down and I'm scared. The best thing you can do is stay the course. The next idea that I had here was on buying a home, and I put this in here because I know so many of you are probably going to be thinking about this in the next year or two. Gosh, I was 22 when I bought my first home, and I was a fairly young home buyer. I imagine some of you will be as well. The link there that I have to what I call my favorite mortgage calculator, if you want to Google it, it's Dr. Calculator. You can Google for that and you'll find it. But the thing is that I don't want you to fall into this trap of, oh wow, how low my monthly payments are going to be when I buy a house. I want you to go in with your eyes wide open, understanding the pros and cons. There are definitely pros of renting. I can't tell you how many times something expensive like an air conditioning has broken at my house, and I think, boy, I'd love to be a renter about right now. And so you want to go in with your eyes wide open and think about these pros and cons. So what are some of the pros of being a renter? Well, certainly you have flexibility. You can move around. You don't have to worry about selling a home. You just end your lease and you're gone, right? You don't have any upfront costs. There's no closing and mortgage fees and all that kind of stuff. You just show up and you pay your rent. If something breaks, you call your landlord. When you buy a house, it's quite the opposite. Much less flexible. Difficult to move. You have to put your house on the market and wait for somebody to buy it, and then you've got expenses associated with that. Something breaks, it can be really costly. The most expensive thing that I've had are air conditioning units, and those run $5,000 a pop. I've got two of them at my house. One has gone out already. I expect the other one to go out in the next year or two. And so those are these expenses that you think, wow, that really increases the cost of home ownership. But you can't look at it as a $5,000 expense. You have to look at it as, over time, what is it costing me to live here? Certainly the home repairs can be costly, but the upfront closing costs, even getting into a house, can also be costly. And we'll talk about mortgages here in a second, but just buying a home, the fees associated with that, the appraisals and the legal documents, can be costly. Hopefully I haven't dissuaded you from buying a house. Let's look at it from the other perspective. What are the pros of buying a house? Well, you're going to build equity. That means you're going to have value in your home. Sometimes you can have roommates. I did this. When I owned a house, I had roommates that paid me several $100s a month, and that covered my mortgage. You can lock in a monthly payment. When you're a renter, the landlord can call you up at the end of the lease and say, hey, it's going up $100 next month. That can't happen when you have a fixed mortgage. That payment stays the same. Currently, we're in an environment where the interest rates are just incredibly, incredibly low. So that's definitely a positive. And as I mentioned earlier, mortgage interest and property tax are tax deductible, so that's going to bring down your overall tax bill. On the other hand, if you're a renter, you don't get all those pros. You don't get to build equity. You might run into bad landlords. You might run into property that's not taken care of, or have these huge rent increases. So those are the things that you have to weigh. I think it depends a lot on your financial situation, a lot on how long you think you're going to be in an area, whether you're going to need to move frequently, and honestly, just your personal preference. One of the big decisions that you'll have to make as you decide to buy a home, you get into that process, is the type of mortgage you want to have on it. Mortgage is just a fancy word for home loan, but there's two ways to do it. One is a fixed rate, and that's exactly what it sounds like. It's a rate that doesn't change. The other is an adjustable rate that says we're going to fix it for a set number of years, and then we can adjust it after that. And because you're giving up that guarantee of it being fixed, that first few years you're going to get a better rate. Well, why would you do that? Well, besides the cheaper rate, you may say to yourself, it's fixed for 5 years, I'm only going to be here for 5 years. Or it's fixed for 5 and I'm going to be here for 7, so I'm going to come out ahead. Maybe you're expecting rates to go down, which I can't see how they would go much lower than they are now, but maybe that's your assumption. You're going to see some other terminology when you buy a house, things like points or closing costs. Points are just another word for percentage points. They say it's a 1 point to buy down the rate. That means it's 1% of the cost of your home to get the rate they're offering you. Closing costs can be a lot of things. Origination fee is just another word for fee that we're charging you to allow you to borrow from us, and some banks do that, some credit unions do that. Attorney's fees, appraisals fees, inspection fees. What you want to do is get a good faith estimate from each of your potential lenders, and that's going to tell you and help you decide whose loan is going to be the best. You might have one that's got a lower rate but a higher upfront fee. Might be the opposite at another place. So you're going to have to do your own math, run your own numbers, but that's the kind of thing that I want you guys to think about. Don't go in blindly and get one quote from a bank and think that's the best you're going to do. Shop it around. Go get 3, 4, 5 good faith estimates and understand the differences out there. You may do better at a credit union. You may do better at a mortgage broker. You may do better at a bank. You just need to shop it. Go use some web tools and find out what's out there. This example, I think, is pretty straightforward. I said $175,000 townhouse, and you're going to put 20% down. You're going to borrow 80%. So that's $35,000 down. That's fairly typical, 20%. In this scenario on the left, you're going to get a 5-year, what they call it a 5-1 arm, which means it's fixed for 5 years, and then it adjusts every 1 year after that. You're going to get that at 3, or on the other side of the equation, you can do a fixed 30-year at 4%. Well, you're going to have other fees like insurance and property tax that are going to be there every year, and then you're going to be able to calculate your monthly payment. So your monthly payment on the adjustable rate might be $790 and then $868 on the fixed, but then after 5 years, that one on the left is going to start to adjust. So that's how you have to think through the pros and cons. The next thought, I know we're almost out of time here before we wanted to get some questions. The next thought is going to be insurance. And I want you guys to think about this. I don't know that you've ever thought about insurance in these terms before, but on the left-hand side there I've got likelihood of something happening. And on the top I've got the impact of that thing happening. So let's think through some of these, right? Let's say you've got a $30 MP3 player, and you're worried about that it breaks. Well, the likelihood of that happening is fairly low, and the impact of that circumstance is low as well. So are you going to insure for that? No, right? That's something that you absorb, and you say, oh, well, it was $30. On the other opposite end of that spectrum, high likelihood, high impact, say you're going to take up a sport of free fall diving off of cliffs. Your likelihood of injury, death, or something really bad is really high. And the impact of that, obviously death, is a big impact. The answer there is avoid it altogether. Right? We can make those decisions to say avoid those kind of circumstances. Well, when do you want to buy insurance then? So we've got self-insured for low, we've got avoid for high. The perfect spot for insurance is when you have a low likelihood and a high impact. What's the likelihood that I'm going to walk outside my door tomorrow and get hit by a bus? Well, pretty low. What's the impact? Really high. Right? And so that's where I want to buy insurance, and that's where it's cost effective to buy insurance, because I can buy disability insurance and life insurance fairly cheaply, And if I need it, the payoff is going to be really big. On the other end of that, this is sort of a gray area, and you'll have to make your own decision. If you have high likelihood, low impact, typically you're going to self-insure for that, and it really just depends on where in that spectrum you are. And a cell phone is a great example of that. You have a $500 cell phone, you say, well, I have a bad habit of breaking these things, so do you want to buy insurance for it? Well, it depends. It depends on what the rate is, and it depends on how you feel about $500. So that's sort of a gray area. But what I want to impart to you here is those other three. You self-insure when it's low-low, you avoid when it's high-high, and you buy insurance when it's low likelihood, high impact. So types of insurance, I got 6 of them listed here. Health insurance you guys are familiar with, and a lot of times that's subsidized by your employer. I don't know if you guys even know that the rate that you often pay, even if they're saying, oh, you pay $50, $60, $70, that's hugely subsidized by your employer if you were to have to go out and buy that on the market. Auto insurance, just basically divided into 2 parts. One is the liability part. It says, are you personally liable if you run someone over and they are in a coma or they die or something like that? What's your personal liability? And then you have the other side, which is the property side, or what they call collision, and that's the value of the car. You run into someone, their car is totaled, and that's collision. Life insurance, 2 basic types of life insurance. They have term insurance, they have permanent insurance. Life insurance just says if you die, while the policy is active, that they pay off. So term insurance says we have a fixed term, 10 years, 20 years, 30 years, whatever. And if you die during that fixed term, then they're going to pay. And at some point in your life, that policy is going to expire. It's no longer going to be inside that term. And at that point, the policy is no longer valid. Well, from an insurer's standpoint, that's a much better risk because a lot of people are going to outlive that term. You're 20 years old, you buy a 30-year policy. If you make it to 50, they're in the clear. They don't have to pay. The opposite of that is the permanent insurance, which says as long as you're paying your premiums, they have to pay off when you die. So you could live to 110 years old, you pick the bucket, the insurance company still has to pay. So clearly, that's going to be more expensive because at some point, the insurance company is going to have to pay. Now, what do I recommend for you guys? Well, the idea of insurance is to provide where you're no longer providing, right? For the person that's deceased is no longer there to provide for his or her family, the insurance takes that burden. So what makes most sense for a young married couple or a young person with children, they're trying to protect their earning power, is to have term insurance that says, hey, my kids are, well, personally, my kids are 2 and infant, basically. And so I say, well, 20 years, they're going to be out of the house. So I'm going to buy a 20-year term policy that carries me to the time that I no longer have kids in the house, and then after that, it's going to be over. And so that's going to be fairly inexpensive for me. I can tell you about what it is. For a person, around 25, you buy a 20-year policy, something like that, you're probably going to pay about $400 or $500 a year for $1 million in coverage, right? That is a screaming hot good deal for you as an individual to provide for your family, your kids, your future spouse. So it's something to think about. Disability insurance, you guys probably don't know this, but you're much more likely as an individual to be disabled at some point in your life than you are to be killed. Think about how many people you know that have had some sort of injury where they've not been able to go to work for a while. They've pulled muscles in their back, injury from a car accident, something like that. Maybe it's a surgeon who breaks his hand and is no longer able to operate, right? That's where disability insurance is going to come in. So the idea of disability is that if you are injured and disabled and unable to perform your job, they're going to pay a certain percentage of your salary. Typically like 60%, I think, is the most common number you see. And by the way, disability insurance a lot of times is provided for you by your employer, so look into that and see if they're providing that for you. Certainly before you go out and buy it on the market. A lot of employers provide that as a benefit. The next one is homeowners insurance, renters insurance. It basically says, again, it's sort of like car insurance, right? You've got the liability side and you've got the property side. So if on the property side, your house burns down, well, that loan is still at the bank, so the insurance company steps in, they pay off the policy and pay for you to have a new house. The other side of that is the liability side. Somebody comes over to your house one day and you've not de-iced the steps and they fall down the steps, hit their head, and have a concussion. There's going to be some liability there, and then your homeowner's policy is going to cover that liability. Now, the last policy I want to talk to you about is an umbrella policy. You guys may never heard of this. An umbrella policy is its whole purpose in life is to fill in the gaps. So let's say you have $300,000 in liability coverage on your auto policy, and you get into an extremely bad accident. Maybe there's multiple people that are injured, and your liability from that accident turns out to be $500,000. And because your liability policy from your car insurance only has $300,000 coverage, well, you're on the hook for $200,000 that you're not covered for. That's why you have an umbrella policy. You have that umbrella policy as a second layer of protection. If the first thing, like your auto or your home, can't meet the requirement, that's when your umbrella policy fills in the gap. Umbrella policies typically are sold by the same companies that sell your home and auto, and they're extremely cheap to provide peace of mind. $130, I think, is what I'm paying for my umbrella policy, $130 a year. Extremely, extremely good deal. So the last thought I wanted to get to is one of financial advisors. Now, a lot of people can call themselves financial advisors, and they're legally allowed to do so, but there's a huge difference between a good financial advisor and one that's a poor financial advisor. A good financial advisor is going to be able to direct you, show you opportunities you didn't know you had, help you avoid huge pitfalls and bad decisions, help you diversify, help you allocate your portfolio, help you make these decisions that we've talked about. That's a good financial advisor. A poor financial advisor is going to be one that charges you with excessive fees and burdens you throughout your life and has a negative impact on your earnings. He steers you into options that are maybe not the best fit for you, but maybe put more money in his pocket. So very, very important, if you go the route of a financial advisor, is to vet that person and to understand who they are, how they get paid, what licenses they have, what credentials they have. And so I want to encourage you, if you decide to go this route, and I think a lot of people probably should, but to do your due diligence. Just because someone's passed or has a license certainly doesn't mean they're competent. So there's no reason to think, oh, this guy has a Series 65 or a Series 6 or a Series 7 or whatever he may have, and think, wow, that he really knows his stuff. Don't fall into that trap. A lot of times, and this is tricky, and I want to say this in a way that I'm not trying to be negative, but I want to say this in a way that you go in with your eyes fully open when you talk to an advisor. And I've got some positive things on the next screen, but I just want to make sure that you understand that when you go talk to someone, what they recommend may or may not be the best thing for you. You go in and your number one priority is to protect yourself and to understand what they're recommending. Right? One of the best questions that you can ask, and this is not in any way offensive to a financial planner, I would hope they get it every single day, is to ask how they are compensated, right? Everybody's got to make money. They have to provide for their family too. But where does their commission come from? And by understanding that, then you're going to be able to more fully understand where their loyalty lies. A lot of financial planners are actually insurance salesmen. The person that's recommending that you buy this variable annuity as your insurance and as your savings vehicle in a very nice way, you ask and inquire about how they're compensated and where their salary or their commission comes from. And they say, well, I get residuals, or I get compensated through this variable annuity, or the insurance company pays me. That's what you want to know. And that way you can make a decision and say, well, is that really the best fit for me, or is that the best fit for him? So just to give you a quick rundown, one is commissions. Another way is they get a piece of everything that you have in your account, and they take that every year. Or another way is hourly. You pay them like you might pay an attorney or a CPA. You pay them for their time. So understanding how those work will more effectively allow you to hire the person that you feel like best represents you and best fits your needs. I've got a couple of resources down here. The first one I want to tell you about is NAPFA. That's the National Association of, I believe it's Professional Financial Advisors is what that stands for, NAPFA. And you can Google that. I think it's napfa.org, and find an advisor in your area. All of their advisors are CFPs, that's Certified Financial Planner. That's a good credential. It's similar to like a CPA. It basically says this person has done three things. They've gone through a series of education, which is fairly rigorous. They've passed a very intensive 2-day exam, and they've been in the industry and been practicing for more than 3 years. So that's a credential that you want to look for. Don't fall into the trap of seeing letters beside someone's name and thinking that they're impressive, because there are plenty out there that aren't so impressive. Another organization that I want you to look at is called Garrett Planning. You can Google that. It's the Garrett Planning Network, and all of their advisors are hourly. So you can call somebody up, go sit with them for a couple hours, they'll send you a bill for their time. And so you know that, well, hey, they're not getting commissions, they're making recommendations based on what's best for me. The third thing that I want you to do, certainly before you commit to work with someone, is do an advisor search. You can do that search through the SEC. Just type in their name, find out if they have any violations or issues with the SEC. That's definitely something you want to know about someone that you're working with. Final slide here is just some more resources. I mentioned Bogleheads earlier. I think it's one of the best resources online. People in that community that are just incredibly helpful and just a vast amount of knowledge. So they do have a forum there, but they also have a reading list that I mentioned, and they have a wiki, and that wiki is fantastic as far as up-to-date information on lots of different topics. The last one there that I want to refer you to is if you're just getting started with this and this is completely overwhelming, I want you to go Google Clark Howard Investment Guide. Clark Howard, if you don't know who he is, he's been a consumer advocate now for 20 or 30 years. He's on the radio daily. But he's put together an investment guide that has 3 layers. New to investing, I'm sort of at a medium level, or I'm at an advanced level. And based on your level of comfort and your level of understanding, you can choose one of those, and his guide will walk you through setting up an account and making some of those initial decisions. All right, so that is actually it for me. Hope you guys have gotten a lot out of this. This is something that you can probably tell, this is something that I'm really passionate about and have been passionate about for years and years and years. I did the CFP program at Duke, and I took the CFP exam and passed that a few years ago. The only thing that I haven't done in that certification process is the 3 years in the industry, right? So it is something that I'm definitely passionate about. I hope you guys will take this to heart and just continue to execute it. Start reading, start getting interested, and the best thing you can do for yourself is to educate yourself and empower yourself on these financial topics. It's gonna open up a world of opportunity to you later, to not live paycheck to paycheck, to have money set aside in your retirement, in the bank, in your stocks and bonds, in your portfolio. So best of luck to all of you. I hope you guys do well with it, and feel free to reach out to me if you have individual questions. All right, thanks a lot.